Today is the 19th of September 2022. My name is David Hickson, and in today's market update we're going to be taking a look at the price of gold. Before we do that, I must ask you to please make sure that you have read and understood these disclaimers. Recently we've been discussing two different analyses in gold. This is the first analysis that we've been discussing, which is based on the standard nominal model that Hurst discovered 50 years ago. As I've mentioned in previous videos about gold, he discovered that nominal model on the basis of his research into the price movements of US stocks. And so there is some discussion to be had as to whether the nominal model that he discovered actually applies to the price movements of gold. There are some analysts who believe that it does, and there are other analysts who would argue strongly against the fact that it does apply. When performing an analysis using Sentient Trader software, or in fact even a manual phasing analysis, you always have to bear in mind the principle of variation, which tells us that the cycle wavelengths and their amplitudes are constantly varying. And so any analysis, even one based on the default nominal model based on US stocks, will account for the fact that the cycles can have greatly varying wavelengths. Perhaps I shouldn't say greatly varying wavelengths, but certainly the analysis process allows for variation in the wavelengths. And so this analysis, which is based on the default nominal model, if you take a look, and let me just zoom in a little bit here so that we can see the recent wavelengths a little more clearly. Let's zoom all the way in there. You can see that the wavelengths at the bottom right hand side of the chart differ from the default nominal model. You will notice that the 18-month cycle, the yellow colored cycle, has recently had an average wavelength of 20.7 months. The average length of the 18-month cycle, according to the nominal model, is 17.9 months. And if you don't understand why an 18-month cycle has an average wavelength of 17.9 months, I would encourage you to download the 10 Core Concepts document, which covers these basic concepts. So, as you can see, the analysis process has resulted in wavelengths that differ from the wavelengths defined in the nominal model because of the principle of variation and the accommodation for the principle of variation in the analysis process. And so because of the fact that we accommodate for the principle of variation, many analysts believe that it is fine to work with the default nominal model when analyzing gold, even though it was based on a study of US stocks. However, you will notice that on this chart we also have a peak analysis. We have markers for the trough analysis at the foot of the chart. Here they are. These are the diamonds that mark the positions of the troughs as found in the trough analysis. We then also have markers for the peaks up at the top of the chart. The important thing is that these are two totally independent analyses. It is not simply a matter of identifying a trough of a particular cycle and then the next trough of a cycle and saying, well, the highest price in between those two troughs is obviously the peak of that cycle. That is not the situation that we have here. What we have done is performed two entirely separate analyses. Each one of those analyses assumes that the cycles are synchronized, either at their troughs in the case of a trough-based analysis, or synchronized at their peaks in the case of the peak-based analysis. I mention this every time I speak about gold because it's a really important concept. The important thing is that, of course, the cycles cannot be synchronized at their troughs and also synchronized at their peaks. However, as I mentioned in the previous market update about gold, I believe the fact that they are not synchronized at either their troughs or their peaks doesn't mean that every single peak is an unsynchronized peak, if that makes sense. And so I'm not going to continue that discussion here because that could get a little complicated, but if those concepts aren't clear to you, I would encourage you to go along to our Discord server, where there are many experienced analysts who would be very happy, I'm sure, to engage in a conversation about that. The important thing about gold, as I mention every time I make a video about gold, is that it is probably true that the cycles that are influencing the price movement of gold are mostly synchronized at their peaks. I say mostly because, of course, there are occasionally synchronized troughs as well. And so when considering an analysis of gold, we should usually focus on the peak analysis. And in the case of gold at the moment, the peak analysis is very clear. We had a very prominent peak, probably a peak of at least 54-month magnitude, but possibly even 9-year magnitude over here in 2020. That's that peak over there. Now, an important peak, of course, means that the overall trend of gold is probably going to be to the downside. The next important peak that we experienced was this 18-month cycle peak, which occurred earlier this year. When the peaks are synchronized, we end up getting W shapes in the market as opposed to the M shapes that I usually speak about when discussing the analysis of a stock or stock market. And so the peak analysis, as I mentioned, has been really very clear. And if you take a look at the videos that I made about gold at about the time that the 18-month cycle peak formed earlier this year, you will see that we were at that time anticipating an 18-month cycle peak. The peaks have continued to be very clear in the analysis, and if we zoom in over the period of time that has elapsed since that peak, you can see that we have a good clear 20-week cycle peak over here in early August. However, the peak analysis is getting just a little ragged, as you can see from these nests of highs. Here is the nest of highs for the 80-day cycle peak. Here is a nest of highs for the 40-day cycle peak. The 40-day cycle peak probably formed over there at the beginning of last week. And so over here we have the next big peak which we are anticipating, which is the 40-week cycle peak. However, I have left the trough analysis on this chart because often the trough analysis, even though gold is clearly influenced by cycles that are synchronized at their peaks, often, I would say, the trough analysis provides us with some useful information. In particular, at the moment, you can see that according to this trough analysis, gold is now coming down into an 18-month cycle trough. However, the trough analysis is really not very good, and so I encourage analysts when they are watching the price of gold not to focus too much on the trough analysis because it can be a little bit misleading. And at the moment, this trough analysis is a little misleading. We are certainly expecting a trough of perhaps 18-month magnitude, but the important thing is going to be to focus on the peak analysis. Let me just zoom out and spend another moment speaking about this trough analysis and why we should probably not pay too much attention to it. First of all, let's take a look at this 54-month cycle trough over here at the end of October in 2020. That is that trough position in price over there. As you can see, there was a much lower trough in March of 2021. And so that's a bit of a question mark surrounding that trough position. We also had a bit of a spike down over here for the 40-week cycle trough. Then the 20-week cycle trough over here at the beginning of this year is this not very significant trough that has formed over there. And so when approaching gold, I like to keep the trough analysis in the back of my mind, but focus much more on the peak analysis. In fact, what we might do here is hide the trough analysis so that we are only looking at the peak analysis. And now let's discuss what we are expecting to occur next in the price of gold. Clearly, gold is moving down at the moment, and it is expected to form a trough. It's moving down from the 18-month cycle peak earlier this year. The next 18-month cycle peak, you can see, is a little bit staggered over here. It's a little bit messy, but it is expected sometime next year. So generally speaking, we would expect price to move from an 18-month cycle peak down into an 18-month cycle trough, and then bounce back up again into an 18-month cycle peak. Broadly speaking, that is exactly what we are expecting. So we would expect a 40-week cycle peak, of course, to form at about the midpoint. Let's display the composite model line as another way of visualizing the implications of this analysis. Here is the composite model line, which takes all of the information contained in the analysis, and this composite model line is based only on the peak analysis. I have not included the trough analysis in this composite model line, and as you can see, we are expecting a trough to form around about now. we are looking at a not very significant peak forming over here towards the end of this year. That's right, at the end of this year, that would be the 40-week cycle peak. And then, of course, price will move down again. And then we're looking at another peak over here for the 18-month cycle peak. You can see that we are expecting a W shape to form in the price of gold. The problem with focusing on the peak analysis is it becomes fairly difficult to define exactly when the troughs are going to be. The reason for that is because the peaks tend to be very sharp and isolated when the cycles are synchronized at their peaks, whereas the troughs tend to be rather rounded and not so sharp and isolated and a little bit difficult to identify. That is a fact of life when it comes to gold. But I always enjoy exploring different trough analyses, and in the previous video that I made about gold, I discussed the results of an initial cyclic model analysis, which we will take a look at again now. The initial cyclic model analysis places more emphasis on the results of the spectral analysis that is performed by Sentient Trader at the beginning of every analysis process. You can see that I have influenced this analysis slightly by positioning the 54-month cycle trough at the beginning of May in 2019. I should point out, first of all, that the peak analysis is exactly the same in this analysis, and so we don't need to discuss that any further. The only difference here is a possible difference in the trough analysis, bearing in mind the disclaimers I have already made in terms of the trough analysis not being as important as the peak analysis. However, this analysis is fairly intriguing, as I mentioned in the previous video about gold where I presented this analysis, and what is particularly intriguing is the possibility that this move down is going to be a trough not only of 18-month magnitude as we saw in the other analysis, but it might be a greater magnitude cycle trough, perhaps a 54-month cycle trough, although you will notice that the wavelengths of the cycles at the bottom right-hand corner of the screen are fairly different to the wavelengths of the analysis that was performed using the default nominal model. The reason for that is that the spectral analysis performed at the beginning of the process revealed the presence of different cycles than the cycles that were found by Hurst in his definition of the nominal model 50 years ago. And so it is just possible that the trough that gold is now moving down into is going to be a more important trough than a trough of the 18-month cycle. What are the implications of this analysis? When we display the composite model line based only on the peak analysis, you can see that we get a very similar result to the result in the other analysis we were looking at, with the 40-week cycle peak expected at the end of this year. Then price will move down into a trough over here and then come up to the next 18-month cycle peak. That's based only on the peak analysis. What happens when I add the trough analysis to the composite model line? This is what happens, and as you can see, because of the possibility that a very important trough is going to form soon in gold, that provides us with a more bullish possibility in terms of the composite model line because of the influence of the trough analysis. However, again, I will reiterate the disclaimer when it comes to gold, that is that we should be focusing more on the peak analysis than on the trough analysis. But it will certainly be very interesting to see what happens as time passes and see how price responds to the upcoming peaks and to the trough that gold is now moving into. I do hope that you found this market update useful and interesting. If you have any questions, please join us on our Discord server. I will provide a link to the Discord server in the description below this video. And of course, you are very welcome to ask any questions you have in the comments below this video.